It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Lower North Shore head-to-head between Mossman versus Lane Cove, with Mossman an ultra-premium harbourfront flagship suburb, and Lane Cove, a highly sought-after family leafy favourite. Let's just have a quick breakdown here. The median house price for Mossman is just over 5.3 million. Lane Cove, on the other hand, is 3.2 million. Annual house growth, minus 5.3% for Mossman. On the plus side, 2.3% growth for Lane Cove, which means that Lane Cove is outperforming Mossman by 7.6%. Let's have a look at the median unit price. Mossman 1.3 million, Lane Cove just over 980 grand. Mossman sits 344 and change. Therefore, Mossman is sitting around $344,000 more expensive. And really interesting with the annual unit growth. Mossman in the negative territory, 15.1%. Lane Cove, 6.2% on the positive side, which means that Lane Cove is outperforming Mossman by 21.1%. Right, let's take you to Sydney right now and catch up with Michelle May. I just want to cover off first off, because you were telling me off air that you're hearing whispers of banks reducing investor lending by up to 20%. Is that right?
Yes, I recently caught up with some friendly buyers agents here in Sydney, and it's definitely happening. The banks have already pulled the rug under current investors looking to purchase. 20%, I've even heard rumours of 30%, but I can't confirm that. So if you're in the market to buy an investment as a rent investor or owner-occupied, buying your first or whatever, make sure that you check with your broker, because that's obviously a huge, huge drop in your spending power.
Yeah, is it ever? And you're right, they have not wasted any time, the lenders, in deciding, right, we're just going to trim that somewhat. Talking of trimming, first home buyers, they have not sort of backed out of the market. They're still out in force. I think that you're queuing at the moment to get into apartments around Sydney and start negotiating on behalf of these first home buyers.
Yeah, I mean, it's unbelievable, really. But yes, up to 1.5, a lot of activity still over the weekend, queuing to get into. And I would say that it is the A-grade properties that people are recognizing that are still worth buying. And obviously the incentives are still there. The 5% deposit, the share equity, all of that kind of stuff is still there. So people who are ready to buy and have got their pre-approval in place, they're still looking to purchase.
Yeah, there's a lot of these auction campaigns, but if the vendors are listening to their agents, in a lot of cases, the agents will say, well, let's not go to the auction campaign because I think we've got some leads. I think that we can probably sell. Is that what you're seeing? Are you getting those calls from the agents saying, look, this is one that is going to auction, but we could possibly do something before it hits that campaign?
Yeah, absolutely. I'm actually in the middle of something like that right now where the agent has says to me, the auction's not for another 2-3 weeks, but you guys are here. I've got some other people there. Let's do something. Because I think with the market as it is today, with all these, things going on in the world, the budget, interest rate rises, etc., I think agents understand the qualified buyers who are out there, and they rather take the bird in the hand than risk waiting another 2-3 weeks for it all to change and potentially for them to walk away.
Grab your weekly dose of inspiration to help build a real estate portfolio. We talk to the best in the business every day. Learn from the professionals and know your property with us.
Look, mortgage arrears really are driven by a couple of key macroeconomic factors. First and foremost, interest rates, and they affect everybody, and particularly because Australia is a mostly variable rate mortgage market, mortgage arrears are sensitive to interest rate movements. And also property market dynamics and unemployment. And unemployment is key because, loss of income is a key cause of mortgage default. So if we have put a bit of a spotlight on Victoria, we've seen arrears progressively increasing in Victoria for probably over a year now. And that really reflects Victoria's more elevated elevated unemployment rate relative to the other states, but also what's been happening in property markets there. Victoria's property markets, as many of the listeners on this podcast will know, have been softening, and softening property markets can have, impacts on arrears because they can make it harder for those more financially stretched borrowers to voluntarily sell properties to get out of arrears situations. Victoria's held that top spot for some time now.
Let's have a look at Sydney then, because that is also high with budget announcements. What does that look like moving forward?
Look, I think Sydney as well, or New South Wales and Victoria, whose arrears are really largely influenced by what's happening in Melbourne and Sydney, their arrears are higher there as well. For both of these big cities, what we've tended to find is, there are a number of people with higher debt to income levels in these areas because of property prices, higher price tag relative to people's income, particularly, historically. So that makes, borrowers in these areas more sensitive to going into arrears. So, that particularly in Sydney with much more higher debt to income levels there, given property's high price tag, does increase borrower sensitivity to interest rate rises. And we are seeing that play out in the mortgage arrears data. And also, Sydney's arrears performance going forward is going to be impacted by what happens with property markets there, particularly in light of those recent budget announcements and their impact on investors, given that there is investors have quite a large existing property footprint in Sydney. So I think that will be an interesting one to watch to see how that plays out.
Yeah, especially when you guys do your next report. I think the devil is going to be in the detail. Once this kind of packs down and you've got some more of those bullet points coming through around what the investor behaviour is, that could paint a really interesting picture in the future.
Yeah, very much so, particularly around how investors decide to behave in light of these changes. I think will be interesting to see how that flows down to arrears. But I think it's important to remember overall that we're expecting unemployment to remain low, and that is the most critical influence of arrears performance.
Buyer sentiment, let's start right there, because it has clearly softened after the recent federal budget changes and another RBA rate rise. Growth is moderating, buyers are becoming more selective, and confidence has cooled.
I think you've summarised that very well, Craig. We've certainly seen a change in sentiment on the ground, but the results in terms of what's actually being achieved, they're very mixed. We are still seeing some properties sell very quickly with multiple offers or a depth of buyers, and yet in other instances we are seeing a lot of properties sitting a little longer on the market with lower buyer interest, and in these instances we're going to potentially see opportunity for price softening.
Yeah, a major talking point, I think, fair to say right now in Brisbane is investor hesitation. Like with borrowing capacity in the mix, along with tax policy and holding costs, the emotional urgency that we saw in 2024-25, we know that has eased significantly.
It certainly has, and you are not wrong when you state the fact that investors are very uncertain. They are currently, in a lot of instances, sitting on the sidelines waiting for certainty. Right now, we've got all of the budget announcements that have been made, but we don't have anything formally legislated. So until we have that certainty, we're likely to see that demand from investors inhibited simply because of the lack of certainty.
I want to talk to you about the two-speed market also, because higher-end Brisbane homes around that $2 to $3 million range are slowing, with fewer buyers attending inspections and some properties sitting longer on the market. Meanwhile, and I know that we've spoken about this before, suburbs including Logan, and good morning if you're in Logan listening this morning, they continue seeing strong demand in competitive open homes.
Look, it's an interesting market, and I think we need to overlay what we're likely to see in the months that are ahead of us, as well as what we're seeing right now today. You are correct in that the most affordable end of the market here in Brisbane has shifted 6.1% in the 3 months to the end of April, whereas the most expensive segment of the market has only shifted 3.5%. So you'll note in both instances, growth has been positive. However, it's a lot stronger in the market where investors have have typically played, but also where first home buyer activity has been stronger. And that's led a lot by affordability and price point.
You've got bragging rights at the moment, no question about that. Brisbane continues to outperform Sydney and Melbourne due to, well, its tighter housing supply. Oh, shock horror, we shouldn't be surprised. Also, interstate migration and stronger affordability relative to southern capitals. It's always nice to have those bragging rights, isn't it?
It is. Look, I mean, we've just released or just seen some of the releases of SQM listings data, and right now Sydney listings are at a 17-year high, Melbourne are at a 12-year high, and yet Brisbane is still about 30% below our long-term average. So that gives some context as to the undersupplied market that we have here in Brisbane. And of course, whilst the tax changes, the global uncertainty and the rising interest rate environment has impacted demand across the board, in a market that's tightly supplied, that has less impact on prices. And we've seen that play out given the fact that Brisbane's house values and unit values have still shown positive price growth up to the end of March compared to many other capital city markets. That's a strong performance.
We are your local source for unbiased, expert insights into the world of real estate. We are not a real estate company. Our only objective is to help you better understand the real estate market.
Now, we're in Sydney this morning, so we better look at the Sydney listings because property listings across Sydney have increased noticeably compared to last year, giving buyers more choice and more negotiating power. Agents at the moment, they're reporting a growing number of sellers trying to exit before conditions potentially soften even further. Days on market are stretching out across many suburbs, and Sydney's ultra-premium market is splitting into two different scenarios. Trophy homes and elite waterfront assets are still attracting wealthy buyers quickly, while the $3 million to $5 million market is slowing due to finance restrictions and borrowing pressures.
So whereas you would have had, 5 to 6 bidders at an auction earlier in the year, now you're lucky to get 2. We're often seeing, agents grabbing onto buyers and doing deals pre-auction. So it's a wonderful time. And it's very rare, these windows that open up, I've got to tell you. These softer markets don't last for that long. I think this one will last maybe 6 months or so. So a lot of people are hesitating at the moment, but we're finding that the market is a great time, particularly if you're an upgrader. If you are thinking of upgrading your home, you're not going to get nearly as much as you thought when you're selling your home. But then if you're buying a higher price property, there's going to be a bigger discount. So the changeover cost is ending up to be lower. So there's one opportunity for buyers right now in the market, Craig.
Yeah, the Sydney buyers, as you say, they're very active at the moment, but far more cautious than they were during the boom years. You've got this borrowing capacity, which is tightened, as I mentioned. Budgets have reduced by around 10 to 15% for some buyers, and properties with problems are on the market for much longer. What are your thoughts around all of that?
Yeah, we are seeing the days on market blowing out a bit more. I mean, Sydney used to be an average of 42 days, but then when we had COVID, it went down to 10 days. At the beginning of the year, it's around 32 days. So it is trending upwards now. And that's as a result of seeing more listings coming on the market. SQM Research just put out their data and they're seeing quite a significant rise in listings. And that's because people are fearing that the market conditions could get worse. And so they go, you know what, we need to sell. Let's do it sooner than later. So I think the other thing that we're seeing at the moment is the whole budget changes. Should I buy new? Should I buy old? Is it a good time to wait? Should I just buy now? Am I catching a falling knife? All of these kind of typical scenarios that go through buyers' heads. But what I'm seeing out there is investors very much sitting on their hands. They're not really willing to take a punt. But at the same time, I'm out there looking myself to buy and I'm very active. And I'm thinking, you know what? It's actually a wonderful time to buy because there's so much less competition.
Long-term property investing despite short-term market cycles. Now, I mentioned that previous question being a bit of a favourite for yours. I know that this is something also that you can talk to.
The mistake that so many property buyers, whether you're buying a home or investment, that they fall into is following the herd. I get asked, when is the best time to buy? And I say that's the wrong question. The right time to buy is when you are ready. Yes, there are certain timings of the market that you can possibly do a little bit better, but at the end of the day, it's about when it works for you. You know, you've got to get your borrowing capacity right. And at the moment, borrowing capacity is being crimped. I think we're in for at least another 1, maybe 2 more interest rate rises. So if you've got a pre-approval, use it or lose it, I say. Secondly, you've also got to look at the broader market conditions. And if you can buy when there's not many other people buying, that's a great time to buy. But as I said earlier, you know, the fundamentals of the property are we're undersupplied. The government is trying to achieve a 1.2 million home target, and they're going to fall short around 300,000 dwellings. I've done some research, which I released at the beginning of the year, Craig, called The Great Supply Crunch Coming. It's a free download on my website on propertybuyer.com.au that people can download. And I interviewed around 20 of the top economists across Australia. And my thesis is simply this, is that we are not building enough homes, construction costs are too high, planning rules are very complex, we're going to fall way short. So I think in the short term, we're going to see very significant rent rises, more than 5% per annum, which is going to be very attractive for investors. Unfortunately, more investors will be scared away from the market because they're not looking at the long-term factors. I think it's going to become harder for the younger generation to get into the market rather than easier because of the changes that have come in.
We connect you to the best real estate information across Australia. The Real Estate Podcast.